Alright guys, we're talking about GameStop today. So is GameStop a good buy, good investment, good gamble? What is GameStop all about? Should we buy, should we not? Today I'm just going to be going over some thoughts on GameStop, more from the investment side of things. And I have the title label, is GameStop a potentially good gamble? You know, the stock's going up and down like crazy, 50% moves in a day. But it's not a great investment, probably terrible investment in my opinion, but it's not the great even in the best case scenarios. So let's talk about it a little bit. Let's talk a little bit about the business itself. Okay, so if you live in North America especially, you probably know what GameStop is. So the GameStop has a little over 4,000 stores, and over 70% of them are in the US. And they basically break down of their businesses into hardware, software, and different collectible items. And majority of their sales come from the actual hardware and accessories they sell at the store itself, and a portion of that also is the software. And you can see in 2021 they sold a lot more software because a lot more people were at home then, so that's kind of normal and to be expected. So total revenue, as you see, from at least 2021 to 2023, not great, just going down a little bit. And but let's see what else the numbers are. Okay, so going back to the whole revenue situation. 2024, they're expected to do 5.2 billion in revenue. That's about 15 to 18% decrease from 2023. Just showed you the previous slide. And if we look in the past, 2013, 2014, 2015, 2016, it looks like then we had a slight, maybe like 3 or 4% increase, 3 or 4%, yeah, a little bit less here, but looks like for these 4 years we were slightly going up a little bit. But after that, it's just all over the place. It's mainly downhill from here. It's declining revenue. So when you buy this company, you're buying into a business that is growing. You are not buying a business that's growing revenues, unless we go back to like 2010 era to 2014, 15, and even then, the revenue growth was kind of small, maybe 3 to 4%, but at least the business was growing. So when you buy into GameStop today, just know you are not likely buying a business that is growing. This year the revenue is going to decline by around 15 to 18%. So you're buying exactly the opposite. Now, if we keep going throughout this trend from, say 2017 onwards, kind of forget the whole COVID blip, which inflated everyone's sales. If revenue keeps slowly decreasing, are we going to see 4 billion in revenues in the next 10 years? What exactly can happen for the revenue growth to increase? Because for this to be a long-term investment, for your stock to go up in the long term, not the short term. The short term, the stock can go up, down like crazy, which is fine, if you want to gamble. But we're talking about, okay, should I hold GameStop for a couple years? For this stock to go up in the next couple years, one, it has to be at a good price today, which I will argue it's not later. But it also has to keep increasing the revenues and profitability. And it's not clear from the history of this business and the management that they can implement some strategy for the revenue to keep going up like it was in 2013, 2014, 2015, a nice 5-6% every year. So it's not clear that can happen. If anything, it's probably likely, just given the whole competition landscape of gaming in general now, that the revenues are going to keep slowly declining. And that's just my hypothesis, but it's not looking good for them in terms of that. Let's look at their margins now, So the gross margin, the total amount of total sales revenue that the company retains after incurring the direct costs associated with producing goods, right? Just quick recap on what that means. It's not exactly clear that their revenues, that their margins are going up either. With inflation and with the capex and different things that you have to put in it into acquiring the actual product and sales, more licensing fees, etc., margins are slowly becoming lower and lower. When we look at a software company, we get crazy margins, 60, 70, maybe 80%, and That's why tech companies are valued so high compared to their revenues, and other, criteria. But it's not looking good in that aspect either. It's not clear that they can even maintain this 20 to 25% margin. So as gaming becomes more software based, I put this note here, you would imagine that gross margin would increase in the last few years. But it's not clear that in the last few years we are seeing this increase. We're seeing kind of a small decrease. Maybe this is an outlier in data, but it's not clear that this is improving. And a lot of the things that GameStop is doing and a lot of the things that other people in the industry are doing are becoming more just do it from your computer, right? Those type of sales have extremely high margins because you don't have, you're not including the lease costs, the building costs. You have less labor costs associated with that sale. So the margin should be a lot higher. But it's not clear that the business is improving in that aspect. So at best, I would say, the gross margin stays a little bit where it's at, maybe increases 1% or 2%, but it's probably going to be in the 25 to 27% range at best, I'm thinking, in the next couple of years. And that's fine. Let's just keep it at 25%. But just know you're not going to see a big margin growth, if anything, unless the business shifts rapidly in some other direction. The earnings before interest and taxes. If we just look at the history, it's kind of all over the place. Some years great. I was mentioning these years before where they had some revenue growth. So it looks like they were making a nice, nice profit. But I mean, these things can be manipulated by taxes and depreciation and all that stuff. So I mean, I wouldn't pay too much attention to it. But the interesting thing is the free cash flow number is more important. So what they're making, after the taxes and all that stuff, capital expenditures, right? They don't have a crazy amount of stock-based compensation, it seems. So I mean, free cash flow is a pretty good metric to use. But just as an interesting thing, they've not been very profitable. They're not very profitable in the last couple of years. 2019 to 2023. And last year, I think the stock went up a bit because they said, hey, we're going to be profitable, which is great. Their sales, I think, they're becoming more profitable and their cost of revenues is going down, which is good. I don't know if this is a one-off thing. This is just how they're doing their taxes because, EBIT and net income can be manipulated by how your accountants do some math, but they are profitable in one of the quarters last year. So that's good. That's an improvement. I don't know if this is a one-off, but I'm gonna say it's a one-off until they can do it for a couple quarters because the history of it hasn't been great and it's all over the place if you go back 10 to 15 years. So at best, maybe you'll get some slight profitability in the future. I'm not counting on too much growth in terms of profitability. Balance sheet looks pretty decent. If we go to their balance sheet, we can see that, net sales, $881 million. That's down from the first 4 months last year. I don't exactly know why. I haven't looked too much into why. Maybe they just got rid of a lot of inventory in the first quarter last year, and I feel like this is more the case, it's, we're more knee deep into the higher interest rates and higher inflationary environment. So, I mean, obviously, gaming is a discretionary, people are always going to game, but it's a discretionary item, so probably less sales. So that's my guess, but I don't know fully why their sales are down this much, because that's a very substantial, net sales decrease. But other than that, looks okay. They have basically $1 billion in cash, no problem. They had $1 billion in cash last year. Their short-term liabilities that they have to do, $848 million. So that's fine. They can cover all that. And I'll go over some of the money that they raised recently. So they're not in any, you're not in any rush of bankruptcy. I mean, you're not. The company's not going to go bankrupt. It's financially healthy. It's just that the company kind of sucks, in my opinion. I mean, that's at. But it doesn't mean it's going to go bankrupt. It's just a shitty company. So let's go back and let's discuss some other things. Okay. So this is where the company gets really shitty, in my opinion. So the company has a history of diluting shareholders just immensely, you know? And you need to understand the reason of why would you want to dilute shareholders. Well, companies, say biotech companies, dilute shareholders because they need to raise capital to, continue operations. And this, by definition, is bad for you, regardless, because the value of your share is reduced. Your open interest in the company is reduced. If you had 100 shares and the company decides to dilute the float by 30%, you now own 30% less of the business. So your stake in the business is 30% less. Now, in the biotech company's case, they'll do that because, if they don't have any revenues in the beginning, they don't make any product, so they need to offer it, to funds, and so they can get some capital to continue employing their employees and keep going on with the business. But in GameStop's case, it's not exactly clear to me why they would dilute and to this extent they would dilute. So on May 17th, they offered 45 million shares, okay, which I believe was, maybe 10 to 15% of what the total market cap was. So basically on May 17th, they said, hey, we're going to dilute your stake in the business about 10 to 15%. So you now own 10 to 15% of the business less when we offer all of these 45 million shares. And so right away, the stock was going to drop, naturally 10 to 15% depending on how many shares they offer. Now, of course, they don't do this right away, but I think this 45 million shares has already been sold. So, okay, now you own, say, 15% less of the business. But what does that allow the company to do? So 45 million shares, I think at around the stock price it was in May, this allowed the company to sell all those 45 million shares for about $1 billion. Okay, so we saw on that balance sheet, which was before that offering, that they had about $993 million in cash, I think. So let's go check that out. Okay, they had just about a shy of $1 billion of cash. They have $1 billion cash, and then that 45 million in shares sells for like another $1 billion. Okay, so now, as of whenever they completed the offering, late May, June, whatever, so now they have $2 billion of cash. Okay, so if they're slightly profitable now, and when they do lose money, they don't lose a lot of money, you might be wondering, why do they need to sell another $1 billion in shares? Why do they need to dilute shareholders? And my answer to that is it's not exactly clear, but I'm thinking they're taking advantage of the fact that the stock has gone up like crazy. So when your stock goes unnaturally high, if you have an offering or sell more shares, you're going to need to sell less shares. And it's not clear that, their revenues and GameStop can grow. So I believe that management was taking advantage of the fact that the stock was just artificially way too high because of, everyone on Reddit and everyone invested. So that's why they issued so many shares. Okay? Now, here's the kicker. Just yesterday, they offered another 75 million shares. So when all these shares get issued, they're going to get another $2 billion. And they're going to have $4 billion in cash in total. But they just diluted shareholders like another 30%. So from the end of May till, yesterday, you probably got diluted. Your stake in the business is down 40%. So a share you bought in early May is now worth 40% less what it was yesterday. And I think the reason, once again, they did this, I'm sure, is because the stock was going up like crazy just because of Reddit. So you need to understand is that, they dilute shareholders like crazy because they want to hoard cash. Now, why when companies do this is because if they hoard cash, they can do something with the cash so that revenues can grow. Maybe, they'll take one of those billions, put it into something like AI related, and that will start growing the business like crazy again, and that will be good for you as a shareholder. But GameStop doesn't have a history of spending cash wisely or investing in anything wisely. In the past, in 2020 and before, whenever they dilute your shares, they don't invest it into anything useful. So that money that they just diluted you, you might think, hey, okay, my stake in the business is less. But now they can take that cash and invest it into something so that the business can grow. But it's not clear, or the management does not have a history of doing anything useful with that cash. So they sold that cash, and I would argue probably this is just payroll money. Maybe they're going to try to open more stores. They might try to do something, but it's almost like a scam. The company does not do anything useful with this cash, in my opinion, and it's not clear that they ever have in the past whenever they dilute shareholders. If you're going to do something with this money, like invest in like some AI thing or do something so that revenues can start growing like crazy again, diluting can make sense. But when you're a company that is break even, slightly profitable, maybe slightly unprofitable, and you have $1 billion in cash, it's not clear that you need to do that yet. But the $1 billion extra in cash and then the extra $2 billion extra in cash, okay. So they did that, and now they have $4 billion in cash once all of that is going to be done. Okay, so this is just to illustrate. If you look in February 2020, there's 257 million shares outstanding. Okay, now as of January 28, 2023, so this was a while ago, there's going to be a lot more now. There was 304.6 million shares outstanding. Could eventually be, like I said here, 415 million by the end of this year. Basically, I've lost, I think it's even more than 30. You basically lost 40% of your share value once they choose to execute both offerings in totality, right? They do these things in segments. You now own 40% less of the business, which could be okay, once again, if they did something useful with that cash. But in the history of this company that I've been researching, I've been reading, it's not clear that they ever did something useful with this cash, there's a lot of stuff with like crypto, maybe they could do some AI stuff. I'm not an expert in this, but they haven't done anything like this. It's just cash sitting there. So it's inherently bad for shareholders. Some people said, hey, they're going to put in treasuries, get an extra, and get 5%. So they can just start stacking up 5% of cash. 5% of 4 billion is a lot of money. That's what someone said on Reddit. Well, that doesn't make any sense. You took a 40% dilution to your shares so you could get 5% in a treasury. That's like saying you lose 40% of your money to get 5% somewhere else. It doesn't make any sense. That's a very silly argument, right? They need to do something with this money big to offset that 40% decrease in shareholder value, but they have not in the past. Okay, so here's GameStop. Ups and downs. Recently, this crazy up, and you'll see in history, and there's a picture of it somewhere. Every time the stock runs up to somewhere here, this is right now over here, they dilute shareholders. Dilution is inherently bad for shareholders in an ownership sense. And like I said before, but money from an offering can be used to invest in the business, CapEx, OpEx activities that can fuel growth for the future, which will offset the dilution which was decided by management. And I'll revert to my previous statement, they haven't done anything of the sort. Okay, now another reason why I might think they might be diluting shares is that they want a little bit more cash because of these reasons. So I was reading in the annual report, they have a bunch of stores leases that are expiring, right? They did have the short-term liabilities, which is kind of close to their cash. So once these leases have to be reinstated, I don't know if they're going to keep every single lease. Their rent is naturally going to be higher. Leasing companies, interest rates are higher. They increase the rent by maybe 5%, whatever the kind of thing that they're allowed to raise depending on that locality. So the lease cost is going to be higher. So I haven't done the math on how significant that lease cost could be, but I can see why from their perspective they want a little more cash. But for $3 billion, it's kind of crazy. Okay, some thoughts. And kind of final thoughts. You're paying for a company that rarely produces profitability historically. While this year is certainly better, you know, they're more profitable and it looks like they're allocating capital a lot better. Just read this part right here. There's nothing to me suggests that this is not a one-off. It's not clear to me that this is a trend, you know. When they are profitable, it is barely anything at all. This is just barely profitability. And revenues are decreasing over the last couple of years, since, you know, the mid-10s, 2010s. Gross margins aren't improving at all. And if anything, you could argue maybe they're even getting slightly less. So, today GameStop I think is worth around $9 billion. I think around $30, it's around $9 billion if I'm not mistaken. This would require, you know, in my calculations, I'm not showing them here, this price right now would require them to grow revenues at least 4 to 6% like they did, you know, I think it was 2010, 2011, those couple years. And improve their margins a little bit and consistently improve their growing free cash flow. You know, so they would start needing, I think they have negative free cash flow now, but they would start needing to go up a little bit, you know, just small increments. And they'd also need to increase their revenues, which, I mean, the analysts say this year they're not going to increase their revenue, and I'm really not seeing it happening. I mean, with the competition, Best Buy is also doing bad, and I think Best Buy is a lot better of a business model. Best Buy's not doing great either. A lot of companies, you know, in this sector, so there's a lot of competition, and I mean, I hope I'm wrong, but it doesn't seem like that they can outcompete everyone and increase their revenues, and it looks like their revenues are decreasing. So if I had to put money into GameStop, I would trade it. Management consistently provides bad value for shareholders by diluting and has not produced anything tangible that would fuel impressive revenue growth with this extra $3 billion in the last 2 months. This is not a great investment by my opinion for that reason, but it's a gamble in a trade, and it could be a very lucrative gamble. You know, the stock moves insanely up and down, you know, but you need to be careful. You need to understand that if you're investing in this, you are either one, gambling, or two, you really believe that GameStop has an edge over all the other competition, and that from next year they're going to start increasing the revenue slowly, and their margins. And you need to have a thesis for this. I really don't think this is going to happen. But if you maybe know the industry a little more, or you have a reasoning of why this is going to happen, just make sure that you're aware that, you know, the current price is very high unless they can do X, Y, Z, right? So that's just my thoughts. You know, not financial advice. Personally, I'm not interested. Have a good one, guys. Make sure to subscribe to Mercury Traders and join the Discord for free.